What's up, you guys? Welcome back to my channel here. In this video, I'm going to talk to you about a strategy I use with options anytime I miss out on a certain rally, okay? Specifically, I'm going to talk to you about Tesla because as you can see here, in the past 1 year, the stock has almost 6x'd, and either people made tons of profit or they missed out on rallies and could be beating themselves up, okay? So the strategy I'm going to talk to you about is called Call Debit Spreads, okay? Now to quickly recap, you probably already saw this if you watched my previous videos, but as a quick recap, a call debit spread involves buying a call with a lower strike price and then selling a call with a higher strike price, okay? The call debit spreads, they're bullish strategies where you're betting that the stock price will stay above a certain break-even price, or in this case, you actually want it to stay above the call that you sold so that you can make the full profit as determine the price of the options at the time of expiration, okay? Now, the big advantage of debit spreads is that you don't need any cash collateral in your account, nor does it really matter what the price of the stock really is, because the price of the spread is always going to be lesser than the difference between the strike prices. Okay, so it doesn't matter if Tesla is $1,500 now, whether it's $500 or $5,000. Anytime you want to put a call debit spread, the price you're going to pay for each spread is always going to be less than the price of the spread itself. Okay, by price of the spread, what I mean to say is the difference between the strike price that you bought and the strike price that you sold. Okay, now depending on the break-even price, call debit spreads would allow you to lock in exponentially higher profits even if the stock price doesn't move much. Okay, now the way I'm implementing it on Tesla, for example, is I'm using this website called Options Profit Calculator to show you how I'm doing it. So currently Tesla is trading at nearly $1,540. So what I'm going to do is I'm going to choose September 18th, which is slightly under 2 months from now. And if I want to be really conservative and I expect Tesla might potentially drop in the next 2 months, what I want to do is I want to choose options in such a way that even if Tesla drops, I would still get to keep a decent amount of profit, okay? And if it does drop by a large extent, then that would be a good time for me to actually buy into the stock. So what I'm doing here is to be very conservative. I'm just saying, let's say Tesla will not drop to more than $1,110 by September 18th, and that it would stay above $1,110, okay? So I would buy the 1100 call here, and then I would sell the 1110 call. And what this essentially means is that as long as Tesla stays above $1,110, then I would make a maximum profit of $810, okay? Now how that works is each of the spread is going to cost you $730, and if I buy 3 of those call debit spreads, I would put in $2,190 for each of the spread. And if it stays above 1110, this spread would be valued at $3,000 because each spread would be worth $1,000 each. And since I bought 3 of them, it would be worth $3,000 by September 18th, okay? And that would essentially turn $2,190 into $3,000, which is an $810 profit. If you look at it from a percentage point of view, you can see here that it's a 36.9% profit. If I want to be a little more aggressive and think that Tesla will not drop too much in the next 2 months, what I would do is, let's say I pick the 1310 call, and then I would sell the 1320 call. In this case, my debit is only $517 per spread, which is a total of $1,551 for 3 spreads. And in this case, it would still be $3,000 in expiration because the difference between these strike prices is $1,000, okay? And that now the profit would be worth $1,449 because 3,000 minus 1,551 is 1,449, and that would be a profit of 93.2%. Again, as you can see here, even if Tesla drops from 1,540 currently to 1,320, you would still make a 93.2% profit on your spread, okay? Now, if you're even more optimistic and you think it's just going to go up from here, you could choose an at-the-money call to buy and sell. And in this case, you're only paying $375 per spread, which is a total of $1,125 for 3 of these spreads. And now your total return could be $1,875, which is 167% profit. Okay? So as you can see, you can use call debit spreads in such a way that no matter how much the stock has rallied in the recent times, and you missed out on it, this is a perfect strategy that you can implement to keep making profits until it drops. Now, what I plan to do is, in my opinion, I actually owned about 8 shares of Tesla. My average cost basis was around $400, but close to $800 to $1,000. I sold off a lot of my shares just to lock in some profits, but I really didn't expect that it would go up all the way to $1,500 and even as high as I think almost $1,700 right after earnings. Okay, but no one ever went broke by taking a profit, so I'm not too sad, but I do plan to build my shares up if it drops. But while it drops, about a few months ago, I actually bought this call debit spread, but I bought the $8.95 call and I sold the $900 call, and on expiration by December 18th, this call debit spread would be worth at least $1,500. Okay, this was a 62.79% profit currently, but it can have a maximum value of $1,500 on expiration as long as Tesla stays above $900. Okay, now I might decide to buy one of these spreads that I talked about. I'd rather be a little more conservative and maybe go with the 1100 and 1110 call debit spread. But either way, whichever strategy that you use, as you can see here, the maximum difference between the strike prices for this calls is $1,000, and you will always pay less than $1,000 irrespective of what the price of Tesla is. Okay? The more in the money you get, the more expensive the spread is going to be, and the more out of the money you get, cheaper it's going to be. But again, that's a matter of risk reward. If you choose an out of the money debit spread, then you're more likely to fail on it because Tesla might drop any day. But instead of waiting for it, I use this strategy to keep making intermittent profits while I wait for Tesla to go down a little bit so that actually I can buy more shares. Okay? So I hope that helps you guys. This is a perfect strategy that you can use on any stock that has rallied a lot. You can choose in the money calls to buy and sell as a debit spread and keep making profit while you wait for the price to come down. Okay? I hope that helps you guys. Please leave a comment below if you have any question or concern. Be sure to subscribe and hit the notification bell, and do hit the like button, okay? That'll help out the channel a lot. That's all for today. Thank you guys, and take care.